All right, so we're going to look at a fairly involved question that deals with a production, direct materials, and a direct labor budget for a company called, let's see here, Gerard Manufacturing. And this is kind of a big ask. This is not a piece of cake. So I think what we're probably going to do is break this down in multiple videos so that they don't get really long here. So, and I'll also tell you that we're probably going to have to go back and forth between a couple of pieces of paper. So hopefully that's not too distracting. We'll have the question with the scenario that we'll refer back to from time to time. And then we'll also have to get out some extra paper to be able to get through this. Okay, so it says that this company has projected sales of its product for the next 6 months as follows. All right, and we do in fact have 6 months, January through June. All right, additional information says the finished product requires 3 pounds of raw material and 10 hours of direct labor. So I would point out to you immediately that this, raw material is going to pertain to the direct materials budget, and this 10 hours of direct labor is going to pertain to the direct labor budget. Okay, you probably would figure that out on your own, but there's nothing wrong with making sure we understand things. I'm going to move the paper up just a bit. Okay, so we've got some further information here. It says the finished product requires 3 pounds. I'm sorry. We already read that. Let's see here. Gerard tries to maintain a finished goods ending inventory equal to the next 2 months of sales. Okay. And a raw material inventory, raw material ending inventory equal to 1/2 of the current month's production needs. January's beginning inventories are expected to conform to company policy. Ending raw materials inventory for January was 1,500 pounds. I think they are probably giving us. They're probably giving us January's ending inventory because we do not have information anywhere for December, and we would probably need that to determine exactly what we did in January, because when we consider these types of scenarios, we always have to start with the month that before where we're really going to look at, and maybe a couple of months depending on what the company's policies are. So we're gonna need this information later. Okay. And it says we're going to do 3 things, which you can probably already guess what they are. We're going to prepare a production budget. We're going to prepare a materials budget, both in, let's see here, prepare a forecast of the units and the cost of the raw material that will be required. So how many are we going to make, and what is the cost of those items that we make? And they give us some detail here. This might very well be in the second video. And then finally, we're going to prepare a direct labor budget, assuming a $12 per hour rate for these 3 months. It's going to be the same 3 months in all of these. Okay, so it says prepare a production budget, prepare direct materials budget, and a labor budget. It does not say anything about preparing a sales budget, but guess what? We have to do that anyway, because hopefully you know this. If you don't, you're going to learn it right now. We must prepare for a master budget. We must prepare the sales budget first. Okay? Must prepare sales budget first. Well, that's pretty easy because we can just go right back up here and grab our numbers, right? Yeah. So it tells us that the sales budget is going to be 700 units for February, 1,000 for March, and 900 for April. So I'm going to go ahead. I have enough room here on this piece of paper, and we're just going to do a quick little sales budget. Okay. And so for February, we projected sales of 700 units. That's directly from the scenario. March is 1,000 units. And April is 900 units to be sold. And again, projected sales for the next 6 months, 700, 1,000, and 900 for those months that we are dealing with. Yes, very good. All right. So if that's great and everything, and this is going to be our starting point, and that is our sales budget. Is this line right here? Okay. Just so we know what we're doing here. Sorry, I had that down. I just drew a line, this little arrow here, to indicate that this was basically our sales budget for those 3 months in units. Okay, so pretty obvious, but that's okay. So then, you know, if that's the case, we have to say, okay, well, how much do we want in, you know, in what are we trying to do as far as planning for additional months? So it says here that Girard tries to maintain a finished goods ending inventory equal to the next 2 months of sales. Okay. So this is all the information that we need. We can stop right there. The rest of that deals with raw materials. So I'm going to go back up here. So for February, the next 2 months of sales are 1,000 and 900. So that's 1,900. Okay. So I'm going to make a little abbreviation here. We want 1,900 units in ending inventory, and that's going to give us 2,600 units. Now we're not finished with that, but I'm going to go all the way across first. For March, the months after March, we got 900 and 400. So we're going to come back down here. That's 900 and 400 is 1,300. So I'm going to add those 1,300 units to come up with 2,300 units. And then I'm going to come back up here to April. And the next 2 months are 400 and 300. And that's 700. Okay, so I'm going to add that. And that is 1,600 units. Okay, but we also have to account for the fact that we had some finished goods in beginning inventory already. So let's go back up here and see what we're talking about. See, for the month of January, we accounted for 700 and then another 1,000 units. These are the 2 months after January. So these are 1,700 units that we would have already produced. So we don't need to produce those again. We've already produced them. So we're going to come down here and we're going to subtract out our beginning inventory, which we made in January, of 1,700 units, finished goods. All right, that leaves us with 1,700 from 2,600 is 900 units to be produced in the month of February. All right, so for March, we come up here and we say, okay, well, in February, we already produced the 1,000 units for March and 900 units for April, because those are the 2 months after February. So these 1,900 units have already been produced. So we don't have to make them again. So for March, our production in units is 400 units. For April, we're going to come up here and we're going to say, okay, in the month of March, the month before that, we had produced in finished goods the 900 units for April and then the 400 units for May. So that's 1,300 units. And again, that's 1,300 units that we have already made. We don't have to make them twice. So that's all there is to it. We now have our production budget. We had to do a little sales budget here, but that was really, really easy. We took our sales, we added to it our desired ending inventory based on the criteria that the company had selected to give us our total needs. But then we said, well, wait a minute now, to get to our total needs, we don't actually have to make this many because we already have some beginning inventory. And so whatever we already have in stock, so to speak, we don't have to make. All we have to do, since we've already got 1,700, if we make 900, we meet our production needs for the month. So again, we just take the production needs minus beginning inventory. That gives us 900 units, and then we repeat that process for both March and April. And again, using this chart right here. So what I'm going to do is I'm going to leave this right here for just a moment to give you a moment to get a screenshot of this. And if you didn't get that, you can rewind slightly and then do it. And here we go again. There it is. All right, we're going to do another video, and we will, in that video, we will do hopefully the full direct materials budget, a little bit more involved, so that'll take a little bit more time, but we probably won't go through as much background information, so hopefully that video won't be too terribly long.